Hi guys, welcome to Value Invest Asia. This is our Facebook Live again, our July edition, and very honored today to have Mr. Goh T Ling, for fund manager of Heritage Global Capital Fund, to speak to us here on how do we actually go about profiting from cyclical stocks. So T is actually a specialist in finding deep value stocks that focus on the cyclical cycle. And I'm sure if you have read The Edge recently, he has a piece talking about the luxury watch industry in Greater China. We're going to discuss that with him as well. But let's welcome T.
Hey,
Hi
hi
T,
Stanley.
how are
Hi
you?
Stanley. Good, good.
Yeah,
Yourself?
good, very good. Yeah, and if just want to set the backdrop because previously we already sent out some of our registration form for you guys to send in your question. I think we have a good number of questions, close to 100 now, but of course we can't go through all of them. So I appreciate you guys sending in the question, but we're trying to go through as many as possible. And on top of that, this is Facebook Live, so if you have any questions straight away, drop us a comment, say hi to T, and ask away your question. So maybe give us a little bit background, T. Like how do you got into investing in the first place?
So I actually started investing in around 2011, but what actually got me interested in investing actually started in around 2008, 2009, which if you actually remember, that was during the global financial crisis.
Yep.
Back then, I was still in junior college, and I was studying economics, and I thought that what I was actually studying back in school in the classroom, and I can actually see how the Singapore government was actually applying it into the Singapore economy. So that actually got me interested in the whole finance, economics, and all. And because of my family influence,
Mm-hmm.
we've been in business and finance for the last three generations. So there was some influence there, which actually got me interested to actually start investing and all. So that actually started my whole investment journey. Yeah.
Right, interesting. And how do of course, when you first started investing, I would say, how long does it take you to slowly morph into what you have your strategy right now?
So I think at the very beginning, we started out reading Intelligent Investor by Benjamin Graham. We started out finding net companies in Singapore. And slowly we started, I mean, the AUM started growing. You cannot actually invest into your typical net companies
Mm-hmm.
because the problem is that it's just all the really, really small cap stocks in
Yeah.
Singapore. So that actually has liquidity issues. So we started changing our investment strategy to what it is actually today, which we still find that we are actually still deep value investors, but with a more capital cycle slant to it,
Mm-hmm.
where we actually invest into companies at the tail end of the capital cycle, into companies which are what we consider deep value.
Right.
Yeah.
Okay. So let's talk a little bit about that. When you talk about the tail end of their business cycle, another word that investors like to use are these are cyclical companies or business with cyclicality. And how do you define a cyclical company per se? Do you have example or some of the industry that you frequently look at that you consider as cyclical?
So more often than not, most companies are actually affected by business cycles. Let's talk about home ground in Singapore. The easiest one is actually the property cycle.
Mm-mm.
It has its booms, it has its busts. I mean, back in 2009 all the way till 2013, it was definitely a property boom for Singapore. And come 2014, when the government actually started implementing ABSD, TDSR, suddenly no one actually was actually wanting to invest in property. And come 2017, 2018, we suddenly see this hype again. And I don't know how many of you actually read the news yesterday. The ABSD has increased once more, and
Yeah.
suddenly we have all our property counters dropping 16% today, early morning. So yeah, this is one great example of a cyclical kind of industry. And naturally, you have other industries actually affected by it, like let's say the banking industry, the
Mm-hmm.
construction industry. These are all cyclical companies. Yeah.
Right. Okay. So you give a good example, the property market, especially with the new cooling measures. I just saw. I think the stamp duty got increased to 12%. And and that's quite crazy. And is this kind of so when this happen, is this the starting point where you look at stocks, or when you talk about the tail end of the business cycle? What are the factors you look at to kind of determine whether this is the tail end of the business cycle?
So we find that in investment analysis, one thing we actually notice is that analysts always likes to focus on demand. You always see analyst reports, Remisier reports talking about, because demand is going to be growing, 5-6% CAGR, we extrapolate and we come out with a fair valuation for the company. But with the capital cycle approach, we find that trying to forecast where demand is going to be is something very, very difficult, because trees don't grow to the sky. Demand just can't keep on growing. Whereas we actually look at supply numbers. Supply numbers are actually very easy to actually forecast. So we actually look where the supply numbers will be, because there's actually a time lag.
Right.
So if you think about it, let's say property developers, I say that I'm going to increase supply, but I cannot actually increase supply immediately. At the same time, I can't cut supply immediately because it takes time. So we actually look at the supply numbers to actually determine whether we're actually at the tail end of the capital cycle. So if you're actually asking me, let's say the property industry in Singapore, is it the tail end yet? I'll tell you it's not, because we only started the initial boom, just that it got cut short by the government slightly.
Right.
Yeah.
Okay, interesting. Because I would say from an individual investor point of view, a lot of us will start looking at a cyclical company for them to turn around when the stock price drop. But what you are saying is, stock price can drop, but we shouldn't see that as an indication of when to invest, but rather go back to the data of the industry or the company itself, right? Would you agree?
So maybe let me use an example, and that's the easiest way. So back in 2016, when everyone was actually avoiding all the property counters, if you actually look at the supply numbers of residential housing in Singapore, it started increasing from 2015, 2016, 2017. But from 2017 onwards, you can actually see the supply numbers coming down.
Right.
And come 2018, 2019, 2020, supply was cut by 50%.
Right.
So that's how we actually determine whether we're actually at the tail end of the capital cycle.
Okay.
So there's this saying that we actually have, spring may not be here, but winter is definitely over. So we were actually investing into all the property counters, the bank stocks in 2016, sorry. Yeah.
Right. Okay. So you caught one cycle of it.
Yes.
And once you know that, and do you still relate back to the supply numbers when you talk about when you should sell, or how do you do that?
At the end of the day, one hand is the capital cycle, but within the capital cycle, let's say we do agree that it's in down cycle and all, we go back to valuations again. So happened back in 2016, it was the down cycle for the property market. And at the same time, all your property counters were actually traded at very dirt cheap valuations compared to its historical price to book ratio. So for us, that's an indicator for us to actually invest into these companies. And when it actually hit fair value, we started selling out all these property counters, the bank stocks and all, simply because it hit fair valuation. I mean, it can continue going up because of earnings momentum and all, but you don't know when it actually turn.
Right.
So maybe on hindsight, it was a good thing, because as you can actually see, it actually turned today.
Okay. Yeah. Okay. Just starting to see more people joining in. Michelle, Ian, hey, thanks for joining us. From our question list from the audience, maybe I'll just pick one that is quite interesting. They always we are always concerned. How can we, you as a fund manager, you have a strategy, but we as an individual investor, how can we sort of duplicate some of that? One is I think is asked by, let me see. Okay, so John is basically saying, how do we identify and screen out all this stock? Do you have a screener, or how do we even find this company in the first place?
So we always go back. We first adopt a top-down approach before we adopt a bottom-up approach.
Okay.
So a top-down approach is something like where I want to be investing into industries which are in this downturn, starve of capital, And these are industries that you definitely should know. Like offhand, I can tell you in Singapore, the down cycle is probably the oil and gas sector. So I actually start going to the oil and gas industry, looking for companies which fit my criterias, and before I actually consider investing into these companies.
Okay.
So that's our general process.
Right.
Yeah.
Okay. And when let's talk a little bit about that. When the oil and gas sector, yes, we know that it is in the down cycle. And when you say you find companies within it that meet your criteria, what kind of criteria you're actually talking about?
So the thing about the capital cycle or business cycles is that we all know that business cycle has its ups and it has downs. With every down, it actually prepares for the next up. But the problem is how many of these companies can actually survive to actually see the up cycle.
Right.
So, such as in the oil and gas industry, we find that a lot of these companies have a lot of that. And the chances are they may not actually survive to actually see the up cycle. So the key thing is actually risk management. We actually look at companies with very, very little debt so that they can actually survive to actually benefit from the recovery in the sector.
Right.
So yeah, it's leverage essentially. Debt to equity, net debt to equity, total debt to equity, whatever you have it.
Right. Okay. That's interesting. So you wanted to at least have a safe buffer that the company won't go out of business throughout this low cycle. But for the oil and gas sector, I would say the downturn sort of started 2014, 15. I can't remember, but when you look at this down cycle, how long are you prepared to invest in the market? Because how the oil cycle has been down for quite many years. How long do you reach a point where you say maybe my thesis is wrong? How do you reevaluate that?
So I mean, in 2014, we didn't actually start investing into the oil and gas companies. So I mean, when there's a downturn, we want to actually wait for the point which I call the tail end of the capital cycle, which is when there's a consolidation in the industry.
Okay.
And that's where we actually see in the oil and gas industry in Singapore today, we actually do see a consolidation where we see stuff like Penguin International and a group of investors actually investing into Marco Polo. I think Sam Gui actually invested into Roxy Pacific. Recently, Ezion also managed to do his restructuring. So this is what I call the consolidation phase, and it's only after the consolidation phase do we actually see the recovery in the sector again.
Right.
Generally, we find that it takes about 3 to 5 years.
Okay.
So we are prepared to wait about 3 to 5 years.
Right.
But we didn't actually start investing when the knife was actually dropping from 2014 all the way till maybe around 2016. Yeah.
Okay. So maybe a word of caution for individual investors is when the things start to fall, don't rush in to buy first. Wait to see how it develops, right? So are you invested in any of the oil and gas company right now, or?
We are invested into some of the oil and gas companies based in Hong Kong or Singapore.
Okay.
Yeah.
Maybe
in Singapore, some examples would probably be Baker Tech.
Okay.
Or Penguin International.
Okay.
They are more cash rich, not much debt. Most likely to actually survive this whole saga. Yeah.
Right. Okay. And do you sort of restrict your exposure to one industry in particular, or how do you manage that as a portfolio?
We don't actually restrict ourselves in terms of a percentage for the industry, but we restrict the percentage for each company that we actually invest in.
Okay.
So we roughly hold about 30 over companies. Of that 30 companies, about 20%, 20 of these companies actually constitute to our core holdings, holdings which we actually understand quite well, such as the real estate, retail, and all. So that would probably take about 4% each of these companies. So that's how we actually allocate our cash, our investments. Yeah.
Right. Okay, that's interesting. I think. We have a question from Jensen from Facebook Live. He's asking, do you look at the semicon industry? How do you think about it? Which cycle of business are we at for the semicon industry?
For the semiconductor, it's not that easy to actually tell.
Okay.
I actually talked to some of the industry people. What I hear is that it seems to be at the tail end of the cap of this whole cycle already. Things should actually be recovering.
Okay.
I'm not too sure on this. Don't take my word for it. But I prefer to actually invest into industries which are actually more clear cut. I
Right.
want to be investing into really, really cheap companies, which you want to be reading it in the news every day and telling you stuff like, this industry is cheap. And so in 2016, 2015, I remember reading on Business Times where the Singapore economy was actually compared to that of Greece because
Right.
of the whole property cycle was being down. That's a clear-cut down cycle to me.
Okay.
Oil and gas, I want to be reading it on the news every day. I don't want to be actually investing into companies where it's really neither here nor there, which I call it like it's in limbo. It's neither cheap nor expensive.
Right.
So I'd rather just stay clear of these kind of companies. Yeah.
Right. Okay. So sort of the indication of when you should start the hunting. The hunting ground that you
Yeah.
look for is actually the worse news is it has, the more excited you get.
Yes.
Okay, that's interesting. Okay, we have a other question also on our list. Maybe we can talk a little bit about the even the property market in China. I think Tom is asking, how are we able to see the property sector in China? How do we know that it's in either a bubble or it's in a down cycle right now? How do you view that?
So, I mean, the China market, I find I can't really give you much insights on that. Because to actually be able to tell which point in the cycle you are in, you actually have first look at the supply numbers. But China is so big.
Yeah.
You have maybe, Shenzhen, Beijing, Hangzhou, and each of these small cities actually follow its own supply numbers. So you actually have to track the local numbers and not just base it off the whole of China. Singapore, it's unique because we are so small. It's much easier to actually track because Singapore is just Singapore. We are not going to track, like supply numbers in Bishan compared to supply numbers in Ang Mo Kio. Hong Kong is so much easier to track. So these are two markets that we actually focus on. We don't actually invest into the China A-share market. Yeah.
Right. Okay. That's interesting. Cool. I think we can maybe talk a little bit more about some of your. Maybe you give us an example of some of your previous successful investment, how you derive at that thesis, and walk us through the investment process. Maybe you can give an example.
So I think my experience in investing has been littered with quite a number of successes and mistakes. I'll talk probably a bit more of the earliest successes. It's probably in the luxury watch retailer industry in
Okay.
Hong Kong. So some of the examples are like Emperor Watch and Jewelry, Oriental Holdings, Oriental Watch Holdings, Hang De Holdings. These are three companies that we actually own within Hong Kong in the luxury watch space. So for Emperor Watch and Oriental Watches, we have actually had quite a good success where valuations actually have run up quite a bit because of the turnaround in the luxury watch industry in Hong Kong. Yeah.
Right. So this one, when did that happen for this one?
The turnaround actually started happening in early 2017,
Okay.
but the share price revaluation only started in about late 2017 to early 2018.
Okay. So are you still holding on to the
Yes,
company,
we are
right?
still holding. Yeah.
Okay. But when did you start investing in the
We
company?
started investing in early 2017.
Okay, okay. So that's actually a pretty fast
Yes.
turnaround, right, for your case. I think you have a fan here, Nicholas. Nicholas has been following you. I think he know that you invested in the company BTL. Do
Sorry,
you?
what does BTL stand for?
Yeah, I have no idea as well. He said, could you tell us more about your investment thesis in BTL? Maybe Nicholas, you can explain a little bit about what the company is, and we'll come back to that question. but anyway, cool. Okay, let's talk about the property market in more details. Yes, it's in a down cycle, but property is Singapore is also a very strong REITs market. Would you see the REITs market as the same as the property developers? Do REITs go through business cycle as well for you?
So it really depends. When I actually talk about the property cycle, I'm actually referring to residential housing.
Okay.
REITs, you have many different kind of REITs. You have logistics, you have office space and all. So you actually have to be very careful of which supply numbers you're actually looking at.
Mm-hmm.
I mean, in terms of residential, I can't actually think of any REIT which has residential exposure. Most of the REITs are actually office space, logistics. Those are actually much harder because, let's say in terms of office have different kind of grades, grade A, grade B. So grade A probably is like your CBD area, which actually is able to actually hold up the rental rates much better as compared to maybe grade B or grade C kind of office space. So it really differs, and you have to actually dig much deeper into the portfolio of these REITs to actually understand which point of the cycle you're actually in. Yeah.
Cool. Okay. Okay. But have you ever invested in REITs before?
No, not really.
And maybe why is that the case?
Because the gap in valuations is not actually there, we find. We don't actually see a sufficient enough margin of safety for us to actually invest into the REITs industry. And I think in Singapore, a lot of Singaporeans actually like to chase for the dividend yield from these REITs. So naturally, these companies won't actually be trading at very, very low valuations. Maybe one industry which I was actually recently looking at, which I actually thought was quite interesting, is the hospitality sector in Singapore.
Right.
So you can actually look at the hospitality REITs. It may actually have some interesting, attractive valuations there. Not so much for the fund because I mean we want to actually deliver a certain kind of returns, so we won't actually be investing into the industry. But for the hospitality sector in Singapore, the supply numbers are actually coming down. Singapore government is not actually releasing that much land for new hotels, and I do think that tourism in Singapore will actually pick up. I mean, we are actually building our T5 now, so I mean, if demand increases and supply is not going to increase as fast, it just means that the revenue per room is going to increase. Yeah.
Right. Okay. That's interesting because what you're saying is when you look at the cyclical companies, you want them to go through a wide enough business cycle so that the price disparity will be bigger for you.
Yes.
Right. That's interesting. Okay, I think Nicholas got back to us. He said it's Baker Technology actually. Have you invested in this company before?
We actually still invested in the Baker Tech.
Okay.
That's in the offshore marine sector in Singapore.
Okay.
Our investment thesis is actually very simple. We actually find that the oil and gas sector should be bottoming up at this current point in time. And maybe over the next 2-3 years, from what we actually hear, things should actually start recovering. I mean, we actually do see the recovery happening in the upstream cycle.
Okay.
Your exploration companies like, let's say, BP, Shell, those are your upstream companies. But it actually takes time before the earnings will actually trickle down to the downstream sector.
Yep.
So that's why we haven't actually seen a revaluation in the downstream sector like Baker Tech. So for Baker Tech, I mean, it has practically no debt, cash-rich company, cheap valuations. I can't actually say much else about it because it's just cheap,
Okay.
What more does that say?
Yep. Okay. Definitely. I think Baker Tech has one of the best balance sheet out there in the oil and gas sector. That's interesting. Okay. When you talk about, I think Victor has a very good question. It's not so much about just finding investment, but he want to understand, how can we become, maybe not how can we, but how do you make yourself a successful fund manager? Do you have like 3 guiding principles, or what do you think a good fund manager's characteristic should be?
So I think maybe the first factor should be we should have a contrarian mindset. I mean, if you are investing like 99% of the population, essentially it's just herd thinking. And I mean, money is a zero-sum game. You can't actually just create money and everyone just gets rich together, let's be honest. So you have to actually be investing differently from the rest of the population. But of course, don't be different for the sake of being different. You have to actually be mindful and understand, do you actually see something differently from other people and see some value there? So I think having a contrarian mindset is definitely a very, very important point. The second point would probably be to actually remain calm. I find that we are actually living in very volatile times. I mean, 2017 was an unnaturally calm period of a year, and 2018 is actually more of a normal kind of volatility. that we actually see. So during such volatility as investors, we actually have to be a bit more cautious, a bit more calm, and essentially be able to hold our ground, and not be when you actually see the stock price running up, you want to chase it up, or when it's actually coming down, you start panicking and wanting to actually sell it with everyone else. It always goes back to the fundamentals. You're asking ourselves, is our investment thesis actually still sound? Does it actually still make sense to actually hold the company or sell, to actually sell the company? So I think that's actually very important.
Okay.
And the last point will probably be about having humility. I find that in investing, you may have some good runs, but it's always wise to actually not be arrogant. Always question your thesis. Ask yourself, did you actually go wrong anywhere? And I find that the best example is actually Bill Ackman.
Right.
He had quite a good run, but as you can actually see from the past 1 year or 2 years, his investments actually blew up. Valiant, you have Herbalife, and he actually came out to say sorry and all. But and the reason was because he was overconfident that his investment thesis couldn't be wrong, that he was invincible, and everyone else was definitely wrong. So I think that's actually a very important point, having humility. Yeah.
Yeah. Okay. Yeah, you brought up a very good point. Maybe just give some backstory to those who might not know who Bill Ackman is. He's basically one of the, I guess, most famous fund managers in the US, and he famously shorted Herbalife and bought into this stock called Valiant Pharmaceutical, and Herbalife went up, Valiant went down. So that's basically it. Okay, we have we have a very long question from Cecilia Tan. Thank you for the question. She wants to maybe dig your brain a little bit about what you think of the trade war between US and China. Do you see that as an opportunity? And if you do, how should the investor take opportunity of this?
So I think this whole trade war between US and China has definitely affected some industries. Maybe the soybean industry, which actually affects the pork industry. There's also the threats of tariffs, on the car manufacturers and all. You see Daimler, BMW, the share price is all down. It may actually be an opportunity, but to us, we actually find that things involving political issues we rather not touch.
Okay.
We don't actually know how long this thing will actually last. So I mean, Trump is only in his probably second year. We don't know whether he'll actually win the second elections again, the next term. So you don't know how long more this whole trade war will actually last. So
Right.
we tend to actually steer clear with all these political issue companies. Yeah, that's all.
Okay, interesting. And maybe on that, because when you say you prefer to look in companies or industry with good business cycle, with wide radiance, we talk about property, we talk about oil and gas. Of course, the banks are affected as well. What other industry do you actively look at as well?
Another industry is the luxury sector, like I
Okay.
mentioned,
Yep.
the luxury watches and all. I guess these are your main few sectors.
Okay.
Of course, the probably, especially in Singapore, our three biggest industries in Singapore is actually the banks, the properties, and construction. So it's all fundamentally based on the property sector. So I mean, why the banks are actually affected by the property sector is because most of the loans that the local banks actually give out is for property, the Singaporeans buying property.
Yep.
And the construction sector would naturally be affected by the property sector as well. So you have those three sectors. You have the oil and gas sector, you have the luxury sector. And when I say luxury sector, I actually focus more on the luxury watches and luxury jewelers rather than luxury fashion, because with fashion, it's high volume, turnover is actually much higher. So I tend to actually not invest into these kind of companies as well.
Right.
So yeah, probably these few sectors.
Oh, okay. That's interesting. Okay. Maybe on geographical sector as well, we do have quite a large number of audience from Malaysia. They are quite interested to know, what do you think of the market? Because given that, the property sector in Malaysia is not doing as well, as well. But with the new government, we saw a lot of foreign investors actually exiting the market. But a lot of local investors actually more and more optimistic. So, how do you view that market?
We are actually not invested into the Malaysian market. No specific reason why. I think because we don't actually have much insights into Malaysian market as well. We actually focus more on Singapore and Hong Kong because we find that we actually have more insights into these two countries. We have friends in Hong Kong. We actually get to actually understand what's actually happening on the ground, hear news that what people are actually thinking on the ground, and we don't actually have this kind of insights in Malaysia. And I think in investing, at the end of the day, it's always about having an edge. If you actually have an edge over other people, that actually helps you gain a few extra percentage points in terms of investment returns. Right. So I don't actually have much insights to share on the Malaysian market. Yeah.
Okay. So it seems that your investment process is still not just relying on public information, but rather going down to the ground to do the work to understand what is really happening within the industry. But for an individual investor, would you say that so it's quite hard for us to replicate this kind of strategy? Would you say for retail investors, we should don't look at cyclical at all and leave it to the professionals?
I won't actually say that. We don't actually rely that much of our investment process based on the ground knowledge. It's just that sometimes we actually just want to actually check our information. So let's say, for example, we were investing to luxury watch retailers in Hong Kong. It was all over the news really that retail rents were actually coming down, and Chinese shoppers were actually beginning to actually start shopping again in Hong Kong. So we just actually wanted to check with the local people, is it actually really true? Do we actually see retail rents coming down? That sort of stuff. It's just to actually double check our work. But it's not that the news that we actually got from the news we got was from South China Morning Post, from Bloomberg, and these are all actually available to the public.
Right.
It's just that we just wanted to actually double check our work. Yeah, that's about it.
Okay, interesting. And for this luxury watch industry, when you talk about the three Emperor Oriental and also Hong Li, when you look to invest in them, so is it fair to say that you don't really choose between them as long as each of them pass your own criteria of investment? You don't mind investing in multiple company within the industry?
Yeah, because I think the problem is when we were looking at the luxury watch retailer industry in Hong Kong, all three were actually cheap. And we don't actually know which one will actually revalue first. So it actually made sense to us to actually just buy all three. Right. Whichever actually revalues to a fair value first, we can just sell that out and redeploy it into the remaining two. Yeah, so that's how we actually did it.
Okay, yeah, fair enough. Since you're already looking at the luxury watch industry in Hong Kong, can that be translated to the luxury watch industry in Singapore as well? Do you look at that? And maybe, I don't know if you invested in Hourglass or Cortina, but if not, why not?
We did actually look. So we didn't actually limit our luxury watch thesis into Hong Kong, just Hong Kong. We actually broadened it out all the way to Switzerland, all the way to Singapore. We actually did look at the luxury watch market as well. In Singapore, we did look, but the problem is Hourglass is cheap. But the problem is there's actually a price arbitrage between Hong Kong and Singapore of about maybe 20%, simply because the luxury watches in Hong Kong is just 20% cheaper than Singapore, probably because of the taxes.
Right.
And in terms of Chinese buyers, they tend to actually go to Hong Kong first to actually buy, or Macau, versus Singapore. I mean, probably Singapore, the Singapore luxury watch retailers will actually benefit a bit. But I mean, we are actually investing into Hourglass as well, but we actually size our positions and we actually allocated more money into the three luxury watch retailers in Hong Kong than in Singapore. Yeah.
Okay. Oh, I didn't know that there's a price difference of 20%. So not just on investing, but if you want to buy watches, go to Hong Kong. So I think that was a question from Grace. So I hope T answer your question, Grace. Okay, interesting. would you mind maybe before we go, do you mind sharing maybe one of the stock that you most recently bought, or one of the stock you're currently looking at this moment?
So we are actually looking at the construction sector in Singapore because I mean of the whole. I mean this, irregardless of whether what actually happened last night, today, the en bloc is real. All these property developers have actually bought pieces of land and they have to actually build a property on that piece of land. So the next industry that it will actually benefit from the property boom or the property recovery will actually be the construction industry. You know, companies which supplies tower cranes, some companies which do main con. These are companies that will actually benefit from the whole recovery in the property sector. So that's one industry that we're actually looking at. Yeah.
Oh, wow. Okay. That's interesting. Okay. I think you have given us a lot of ideas to work on, especially if any of you are interested in, investing in cyclical companies. I'm sure. Thank you, T, for all his wonderful ideas that he shared with us. Before we go, I just want to, let you guys know again, T is actually the fund manager of Heritage Global Capital Fund. You can Google and find out more about his fund. And also he runs a website called Value Age. I'll show it up here, where he shares some more of some of his thinking beside and part of his research. So do check that out as well. I'll provide the link for you guys later. Thank you so much, T. I hope we can have you back again soon.
Sure. Thank you for your time.
Cheers.
Bye.